All right, welcome everyone to the Power Passive Investing Real Estate Meetup. I am Matt Aquino, Alina's co-host, and tonight I'll be hosting and presenting the material. Alina is out for the Jewish holiday this evening, so I will. Although I see her picture there, she graciously joined just so that we could set this up and record it this evening. So I'll be happy to co-host tonight and present to all of you guys, hopefully some interesting content. So let's get started. So we'll go through. So tonight's topic is I'll be sharing my insights and experiences from joining a syndication group of acquiring and operating a 32-unit complex from 600 miles away. So I am here in New Jersey, Bergen County, and the apartment complex, which we had purchased a little bit over a year ago, is in Louisville, Kentucky. So we'll go over some interesting stories, some things that we looked at, some things we've experienced over the last year there, and really give you guys a little bit of insight of how we operated it, challenges we had, and just give you kind of a look under the hood here of what I'll say kind of a medium-sized apartment complex acquisition and operation looks like. The usual disclaimer is, especially in today's where everything provided is for educational purposes. So no investments are being pitched, or no marketing, legal or accounting or other investment advice is being given. So just take everything today. It's just kind of a personal experience to be shared for educational purposes. We don't have to go over the housekeeping as we are on the webinar format. So I guess the one thing I do want to mention is if you guys do have any questions, go ahead and place them in the chat box. I'll check it maybe periodically, as maybe I'll pause periodically to see if any notifications popped up. I'll peek at it and look to see if I can answer that question or if I can hold it to the end. And then at the end, hopefully you guys have questions. I'll be able to unmute you all and you can either verbally ask the question, or again, you can use the chat box and we'll do it that way. Here is our contact information. Alina and I always look forward to connecting with each of you. I see a bunch of you on now, many names I recognize from past meetings or folks that I've personally met. Glad to see you guys on and happy to have you here. See some new names as well. Excited to hopefully meet you all and encourage you guys to reach out. We have email listed here. LinkedIn's a great way as well. So just go ahead, feel free to reach out to Alina and I if you have any questions about the content or just real estate questions in general. Happy to always be a resource to people and help in that regard. So with that, I will kick off. So I'll try to keep this to about 30 minutes or so of about presentational content. Lots of different stories. Some I'll try to indulge in, others I'll try to keep at a surface level just to keep it within kind of a 30-minute time frame. We'll go over, again, as I was mentioning, this is kind of my insights. I was one of a few partners who came together as a group, a GP group, to acquire. And we have now operating a 32-unit complex in Louisville, Kentucky. We acquired this property a little bit over a year ago now. So we have stories from the acquisition phase and now the asset management phase, and we're entering the rehab and into the stabilization phase. So I'll go over my background, maybe as by way of start before I even jump in. I'll go over my background just to give you guys a little more familiarity with myself and my experiences and how you guys hopefully maybe can relate to some of those experiences. I by no means have anything above and beyond different that makes me more qualified to acquire and operate. You know, it's an accumulation of experience I've had over time from my day job, from education, from networking. So happy to share to you guys how I got comfortable to get to this point. Then we'll go over specifically about this 32-unit complex, or more broadly, like some evaluation criteria that I and my partners look at when we look at apartment complexes. And this is from both the general partner perspective and also applicable to the limited partner perspective. If you're just looking to invest a lot of the same criteria applies in many ways, almost exactly. So that'll be hopefully insightful for whatever side of that investment equation you like to be on. Then I'll go over some stories from this specific acquisition. I've acquired a few apartment complexes, and they all have their own twists and turns and unique things. So I'll just share a few stories. Some of them are interesting and made it more interesting than we wanted it to be, and others lessons learned, and some things were just completely unpredictable and come up. The third topic we'll get to is just asset management. Since we went through the deal, we closed it, and then the real work begins is managing tenants and managing the business plan and rehabbing and construction and all that fun stuff. So I'll go over some things we looked at there, some things we've been doing, some things we're still doing, and that'll lead us in kind of naturally to the project status, like what's the status of this building and kind of what's the market impacting us, right? We're in interesting times that the market and real estate has been really, really good for so long, and now tides are turning a little bit. And how does that make us think about this property as we own and operate it? So that's the outline of what I'll go over for the next 25 minutes or so. And I'll jump right in. So my background, like I said earlier, I'll keep it as brief as possible, but I am, so I joined kind of out of college. I went into a financial services career, which is kind of twist and turn this way into a bit of a specialty or niche now that I have kind of a project management background and corporate strategy mix, almost like a management consulting type skill set, which I'm applying at financial services firms. So I've been at large investment banks. I've been at a hedge fund / private equity, and did a lot of projects management consulting type work internally within there as well. And I'm now actually at a real estate asset manager, and again applying that same skill set, but within an asset class that I truly love and get to honestly was spending a lot of my quote unquote night hours learning about. So now I get to kind of work within that industry specifically and immerse kind of the skill sets that I had previously built up and merge it with my passion and love for real estate. So, a lot of people have the question, how real estate, how do we, where did you start? How did you get into it? For me, I think the seed was planted early on in my life. When I was 16 years old, I wanted I think it was an N64 at the time. Was basically a gaming system. For those of you that might not even know what N64 is, a gaming system. I was 16 years old, didn't have any money. So my parents basically said, go get a job, try to find a job. And I said, who's going to hire me? I'm 16. I can't even drive myself there. And so they basically said, my uncles, they're plumbers. They own their own plumbing business. But on top of their plumbing business, their retirement plan was actually buying and holding real estate around the block from their plumbing store. So what they had done is what they did actually, they said, all right, we'll hire you. We bought a new, it was a two family that was about 3 houses down from their plumbing store. They just recently had purchased it. They said, for the summer, you can help us demo and do kind of the grunt work inside of that. So I threw a mask on, threw some gloves on. They gave me a crowbar and sledgehammer, and I kind of got to work, got my hands dirty. At the time, didn't even think about the real estate aspect. I just kind of counted the hours to how many hours I had to work to earn that N64, so I can get on gaming and be done with this. But I kind of enjoyed it. I kind of enjoyed seeing the transformation of this ugly home over a few months, get even uglier, right? As you kind of knock walls down and get all the way down to the studs. And see how it kind of gets built back up. So at the time, I wasn't that amazed or thrilled by the experience. I just kind of counted the hours, but it was good, honest work. And I kind of loved actually seeing that transformation. Was kind of cool to see. And once the tenants moved in, I started mowing the lawns for the summer and things like that. So it was kind of like in a way, and then throughout my life, it's kind of, it's all around us, right? So my wife eventually became a part-time real estate agent. So that was kind of another element added to my life as well. And I always just had an interest in it as an investment and as an asset class, but not until I was kind of more established in my career and had earned and saved a little bit more was I kind of ready to start investing into it. So when that time came around, I started seeking some education and networking. Right, I was, I had a big, what at the time, what I felt like was a good amount of money, and nervous to put that at work. And what do I do with it? And what real estate strategy do I even pick? Am I going to try to flip a house, or am I going to put it into like a REIT online and not do anything? Am I going to buy and hold a single family, two family, three family? Just trying to sort out what all these potential options are within real estate. It took me a long time, to be honest, and specifically where to invest. So at the time, I was living in Hudson County, working in Manhattan. I thought, I was seeing kind of prices in Hoboken and Jersey City and kind of all those cities around us appreciate like crazy, right? People were making a lot of money in real estate buying, and then just seeing the value of those properties go up really quickly. So I tried to join that game, and quickly found out that's a really expensive and very speculative start to real estate, right? I just did, even the one or two bedrooms were very expensive at the time. If I wish I had thought back maybe a little bit of if I was more familiar with the house hack strategy, I might have thought of that, but unfortunately had not crossed my my educational plane. So I just looked for places in those areas that I could potentially afford. Wasn't lucky enough to find anything. I wanted to cash flow. I didn't want to buy just for appreciation. So I ended up moving kind of further and further west, right? The further west you go, you get a little bit cheaper of homes, and then the rent's a little bit less, but not significantly less. So you get closer and closer to cash flowing the further west you go, or kind of further deeper into the suburbs or even the rural areas you go. So I eventually kind of found my way, see here on the map, into Sussex County, New Jersey. For those of you that are familiar with this area of New Jersey, it's not your kind of typical, what many people know as the densely populated areas in New Jersey. It's much more rural and spread out. The homes are much cheaper, very old homes. So it's much more affordable. And the best thing of all, I was finding on the MLS, I didn't even need to find off market. I was finding at the time on an MLS cash flowing properties that were, producing 8 to 10 or even 12% if you found a good deal, cash on cash returns, which means, after each month that I could expect some cash to come back to me in the form of a return after all my expenses and all those things. So that felt like a really good place to start. So I jumped right in there, bought two families, and that got it started. So, learned a lot from owning those, and, first time being a landlord, and, doing repairs and working with contractors on things like that, and writing up leases and the sort, right? So you really learn a lot from those. Eventually, the day job was managing these apartments, which were a bit away, became overwhelming. So eventually I had to kind of bring in a property manager to help me out with that. So those were great experiences. And eventually that kind of led me to, okay, how do I scale this? Am I going to end up, do I get 50 of these and build this out and kind of become the landlord of 50 different homes? Well, I was quickly learning each home had its own unique things, right? Each home had a different, some of them had water provided by the town, and others, as the tenants paid for the water, didn't pay for the water. Or some towns had garbage collection, others didn't, so the tenants had to contract that. So it's just the roofs were different, everything was different about each one. So I was just finding it was becoming really difficult to manage the uniqueness about each one, the distance between them. It just didn't feel like it was becoming a scalable kind of a real estate investment strategy for me at that time. So I eventually started looking into apartment complexes, right? How do we get more doors under one roof? So that led me into apartment complexes. Obviously, the price tags of those are much more significant. So I needed to figure out how do we kind of bring more money in, right? So thinking about joint ventures with other folks who I had known were investing in real estate. Or the other model was the syndication model, right? Getting people who were interested in investing in real estate, but didn't want to kind of deal with the management of it, the tenants, toilets type deal. They just want to kind of put their money to work and see the benefits of real estate. So that led me to more education and more networking, right? Because now I'm in a totally different niche, totally different. It's much more commercial than residential. And that kind of led me into apartments, apartment buildings, syndications, and the like. So that whole story led me to now I've been a limited partner in quite a few buildings. And that experience as a limited partner helped me on the other side of it as I became a general partner and lent my skill sets that I could lend in project management and strategy and competitive analysis, underwriting, all my relationships that I had through my kind of W-2 and day job. All those things kind of led to my unique skill set that I could offer to a team to help acquire and manage an apartment building. So that's kind of led me to partnering up with folks who are interested in doing this. So this kind of led to my first kind of what you see now on the screen is kind of my evaluation criteria is first things first, whether you're an LP or you want to be a GP, you have to kind of evaluate the team and the people, right? And there's a lot of different ways and elements to this, right? Are you partnering with people who you trust and you have a good rapport with? That's an investor or a co-GP. You have to kind of have a good rapport and trust. Are their experiences worthwhile, right? In the real estate market, do they have relevant experience that they bring to the table? Are their skill sets, if you're on as a GP, are their skill sets complementary to mine? I don't want necessarily to replicate myself 2 or 3 times over. I want people who are better. For example, I'm not as good at managing construction or knowing kind of the ins and outs of that side of things, the contracting side of things. So I always want to bring someone with that skill set and that knowledge to my team because that's an area that I'm not as strong in. And then availability and focus, right? So I have and had a W-2 job. So, and others, people have limited amount of time. Some people may not have the W-2 job, but they may be spread across many different properties, right? And they may be managing a lot of properties. And maybe that's I need someone on my team that's a bit more focused, or they may need someone rather than me who can spend more time on the project. So it all comes to finding the right team, whether you're an LP investor or GP investor. That's the starting point before you ever consider the market or the property or your business plan. You really got to look at what can you offer and who do you need to partner with. So that's really a start of it. Then you kind of think about, as we start narrowing down a little bit, think about the market. What markets do I believe in, right? Before I partner with anyone and going on a property, I have to have conviction on the markets and where they're going, right? So I look at things like, is the market growing? Are the population figures growing? Are companies moving there and bringing more jobs there? Is the city investing in infrastructure or parks or other interesting things coming to that area that might make it more attractive, right? So you have to look at that. Is the market stable? If you look at past downturns, certain markets have taken bigger hits than others, right? The prices fluctuate a bit more. Is there a concentration? Is that city or town or area really dependent on one employer, right? And if that employer or that company or hospital or whatever it is, that area, if they're over concentrated, if the jobs or and economy are over concentrated on that, that's a risk, right? So you just have to be aware of that and perhaps accepting of that risk, and that's something you have to be aware of. And you think about demographics of every market, right? What's the average age, right? Is there renter population? How many renters are in these areas? And then ultimately you look at things like financials. What's the median incomes? Are there growing wages? Things like that help you kind of get comfortable and kind of pick a market you feel good about as a place to invest in. And then as you pick a market, you want to think about a sub-market. So, if the market is kind of a metro area, in this case, we were thinking about kind of Southeast as a as a market, and then we narrow in on kind of Kentucky and Tennessee as kind of an area we thought was interesting as a group. Then you think about submarkets, right? We identified Louisville, and then even within Louisville, right, there's neighborhoods and parts of the city that are much different than the others. And you have to think about what areas you want to be in, right? There's different neighborhoods. There's A class, B class, and C class. And that kind of comes down to the quality of the buildings in that area, the quality of kind of the other tenants around you, the stores, the offerings, how attractive it is. Lots of things go into that. So you look into kind of access to transportation. Obviously, we all know if you're closer to kind of public transport, that tends to be a more desirable area, but also think about location as it relates to access to highways or key stores, getting the ability to the walkability of a neighborhood. The schools are the schools really good in that submarket, right? A lot of people, oftentimes certain school districts people will pay more to live in certain school districts. That's certainly the case in many areas, right? And are there better jobs in certain submarkets? So all those things you want to think about: visibility, crime rates. You really want to get comfortable and know almost block by block within that market what's the neighborhood you want to be in. And then you just look at the rents, right? What are the average rents in that area as well? So then you're starting to narrow down is what is the business plan you want to attack? Do you want to attack established buildings that don't need a lot of maintenance and you kind of acquire and just keep, maybe you make some tweaks and keep them running? Do you want to do more of a value add strategy where maybe the building is, could use a little TLC, some rehab, and you kind of capture, by improving it, you'll capture a little bit higher rents and maybe improve the tenant class or improve the neighborhood a little bit? Or, all the way down to even development opportunities or redevelopment. You think about some buildings that are maybe more decayed and need more of a kind of a complete rebrand or turnaround. That's a strategy. The higher the risk strategy, right, the more kind of work you have to put in. You have risk of executing that strategy, and you have risk of executing on that business plan. The higher risk, the higher returns you should expect. So as an LP as a limited partner investor, you have to keep that in mind as well. There's bands of returns I would expect based on what the strategy is for that property. The more stable properties I mentioned earlier that need very little maintenance, you can expect lower kind of returns. The value add is somewhere in the middle, and then those redevelopment, you should expect a much higher return, right, for that higher risk that you're taking. So I always think about that, and that's when you come down. Now you kind of walk right into the financials. So as you're underwriting these opportunities, are we underwriting to those targets, right? Can I offer a price on this property that gets me to those targets that we talked about based on the risks I think I'm taking on? So for this Louisville property, for example, we knew we were in kind of a B/C class neighborhood. It was kind of, the neighborhood was improving, the city's improving. It's kind of a B neighborhood with like kind of a C, currently like a C class tenant population. It had lots of room for rehab and value add. So now as we underwrote this deal, we knew we kind of had to reach those mid-teens IRR type returns. That's the internal rate returns to kind of justify the investment in this property. So as we jumped in and underwrote, we kind of you kind of almost back into what price you could offer to make this project viable and make it profitable for you and for the investors. So that's a really key, important part of the criteria, right? You end up underwriting, you kind of think about your business plan, you underwrite for several dozens, or potentially even hundreds of deals, and making offers on a small fraction of those. And then, even smaller fraction, you end up getting under contract, right? So it is a sifting through game. You have to kind of say no many, many times over before you find the right one, right? And you have to make sure it works for you and your team and your skill set. So for this property in Louisville, we felt good about the business plan we could bring, the skill sets we had, and the competition, right? At a 32 unit, the competition is different than a 200 unit building, right? You get a little bit more institutional players and competition coming in at the bigger projects. At this smaller project, we felt we could be competitive in the bidding and with our plan. So, and then that ended up working out, right? And then eventually you get into the due diligence, and that's there's a lot of elements of the due diligence, right? There's the physical due diligence, which we all would know and be aware of, is, you know, how old are the roofs, the windows, you know, what condition are the walkways and driveways in, how old are the, you know, the infrastructure, like the HVAC, if there's HVAC, the water heaters, things like that. What's the condition of the foundation of the building or buildings? So, so we all know that, right? The condition of the units as you walk in, what kind of condition is the floor, are the floors in, and things like that. You also do due diligence on the leases, performing a lease audit to review what the existing terms are of the tenants that are in place. Do we have a lot of leases coming due kind of at a specific time or near soon, right? That's going to be a lot more work if we have several dozen leases coming due right after we acquire it, right? That's going to be, that could be a challenge that we should be aware of. Or do we want to take that on? Is that a good situation for us? Or are a lot of leases month to month? Maybe that says something. Maybe there's a lot of month to month leases that might lead to different problems, or maybe advantages, right? Maybe we could turn the units over faster. So again, that's part of the due diligence as well. You look at the performance of the property, you look at the trailing 12 financial statements, you know, what rents are delinquent, what type of work orders are there, is it deferred maintenance at the property? All these things come to consideration when you're evaluating whether to acquire the property or not. So I'll get into more specifics about the property that we're talking about today next on the next page. So I'm going to pause, see. I don't see any questions. Again, if you guys have any questions, go ahead and place them in the chat. I'll check kind of periodically as I go through here. All right. So specific to this property, I'll just share some acquisition stories. Every property that I've ever been a part of, whether it's small or large, has its own challenges. And what you see here is kind of icons at the top to kind of what I think best signify, especially what I'll call a syndication type acquisition. So once you have all those criteria set that we talked about on the prior page, and you're underwriting many, and you get the LOI accepted, you're under contract, and that, you know, as you see that first icon there, it really begins a sprint at that point. You're kind of now sprinting. You're getting all your inspections lined up as soon as possible. You're trying to go through those lease audits and get all the information from the seller. You're trying to get a visit planned. If, you know, like in this case, right, most of us were in the Northeast, New Jersey, New York, or the Carolinas. So we had to kind of make a plan to get over there and visit the property, walk the units, and get through it, right, to help and further inform our potential investment here. So really begins a sprint. There's just a lot of elements. There's legal elements, the contract phase, negotiation. You have to validate all your underwriting assumptions, right? Things that we thought in our underwriting before when we made that offer, are they legitimate? We actually, as we visit the property, we go visit properties nearby and see, you know, what rents they are offering and what their amenities are, what condition those properties are, and check out our competition. So the visits include detailed competitive analysis as well. So you have to prepare, and then if you have investors involved, that's a whole nother kind of work stream of preparing investor materials and fundraising and speaking to people and getting them comfortable and up to speed with the project, right? You have to get them to view it. They're partners in it as well, right? So you have to get them caught up on all the things you've learned to that point, so that they are comfortable with it and they can kind of, you know, feel as much conviction about it as you do. So really, it's the beginning of a sprint once you get it under contract. The second icon there is then it's a juggling act, right? There's all these different work streams. There's a legal work stream. There's kind of the due diligence work stream, the investor work stream, the underwriting, the competitive analysis. You're managing all these things at once. So the element of team is really important here. I mentioned back on the prior slide, you have to kind of pick the right team and have the right skill sets, the right complementary skill sets in this case, I partnered with a group of guys who I felt really strongly about and trusted. I kind of knew their experiences lined up, and I had different experiences to offer as well. In this project, I undertook some underwriting responsibilities, the due diligence. I performed the market, kind of underwrote a lot of the market analysis for the competitors. Unfortunately, this was, and one of the challenges, actually, one of the interesting stories about this acquisition was kind of right during COVID, which made a lot of things really challenging, even down to our visit. Some of us, actually me specifically, I got sick right before we were supposed to fly out, had to pull myself out of the visit, instead kind of view the pictures and videos and speak to the guys on the phone, as we were there. So, just trusting them as a team, and that just presented a unique challenge for us. It also slowed a lot of things down. COVID, as we all know, slowed things down. The inspectors, housing market was hot. Inspectors and contractors had a harder time getting out there. So that kind of leads to that next phase. There is you at times you feel overwhelmed, and you're juggling this all, and you start worrying, am I going to meet the timelines, or are we going to raise enough money to close this deal? You have to finance it, right? So you're working with the bank and providing the bank with all the information. You put down the earnest money, so that's nerve-wracking as well. So all these things come about. I guess I'll share one. I guess the real story about this one is during the due diligence process, we discovered some foundational issues. So as we're looking here on the picture of this was a 32-unit complex. It was built in the 1980s. I mentioned it's kind of a C-class asset and kind of a B-class area. So we can kind of bring it up to a B-class asset. Then we can capture some value there. These were townhome style apartments, meaning you kind of see every apartment had their own entrance, and they're all kind of upstairs, downstairs, which was nice, unique feel. Nice unique feel that not every large apartment complex could offer. So we liked the asset for that. But during the due diligence, as some of the inspectors got underneath the building and looked at the foundation, we found that actually there's quite a bit of damage to the foundation. Some water damage came in underneath. You can kind of see even to the side of the doors here, there's that grassy area, which kind of led to some drainage issues, which internally kind of over time led to some potential foundation issues. And that was a challenge, right? That brought us back to the negotiation table with the seller. And we had to kind of work out a credit. At times we had to be willing to walk away, right? Because this was a really pricey thing that we previously did not account for under underwriting. So we had to kind of renegotiate and ask for the credits to keep the deal making sense, so you can get us a return. So this deal, that was kind of the big obstacle, and a lot of deals have their own unique obstacles. There's always something different. So that was kind of this deal's story. And then at the end, we're all kind of put your hands up, you cross the finish line and get the deal kind of finalized and through. But that's as we all know, as many of us know who invest in real estate or operate any real estate, that really is it's not the finish line. It's actually the starting point, because now the asset management starts. So I'll give you guys. So now we've operated and owned this property for over a year. We had a kind of a comprehensive unit turnover plan. So I'm just showing some pictures here. The top one here, you can kind of see there's some walkways we needed to repair and things like that. So that picture at the top there is kind of a before. On the bottom left, you kind of see the bottom left. The first picture on the left is as we bought it, the condition, and then the right, although it's twisted there, you can kind of see it's upside down. You can kind of see we brought new countertops to the kitchen. We added some new hardware to the cabinets, some new faucets, and just kind of freshened it up a little bit. We added new flooring in there as well. So really freshened it up quite a bit. You kind of see on the left, it's a little bit decapitated, looking pretty rough. On the right, this isn't, it's not luxury or high end, where that's not the product we were aiming for, which is an important part of your business plan. You have to know what your tenant base is looking for. They're not looking for kind of the super high-end finishes here. This is kind of a working class tenant base we're aiming for. So we want to bring a nice touch to it, make sure it's clean, polished, and bring it up to speed. So again, the next picture on the bottom, third picture in, was one of the bathrooms, the way it looked when we bought it. And then on the right here, you kind of see the far right picture now shows a brand new floor, new toilet, new hardware, new cabinetry there. So just freshening it up goes a long way, right? New paint on the walls and all that kind of, it smells different, looks different, it's brighter. All those things just make it a much more pleasant place to live, and therefore a better product to offer tenants, and you can get higher rents, right? So that's the name of the game, is make the tenants happier and bring in a tenant who's willing to pay a little bit more for a better product, and that raises the value of the property. So those are just some pictures there. On the next page here, I'll just share some specific stories on asset management. There's, again, every property is unique or has its own different things. This one, even like the simplest things, it's just funny to think of something as simple as dumpsters, but actually how big of a headache that became for us at the beginning phases of owning and operating this property. Is there's several dumpsters in the parking lot. So this far left picture, you kind of see a bright yellow one. And it just became, what ended up happening is they were not being collected often enough, and garbage very often, almost on a weekly basis, was overflowing from the dumpsters, sitting outside the dumpster. It was just an eyesore. It smelled terrible, looked terrible. It really brought down the quality of the property. Tenants, as they moved out, were leaving like couches and furniture there, which shouldn't be happening. So it really became kind of a headache for us. So we had to kind of work through, all right, we have to pay a little bit more now than we expected to get the garbage picked up more often. And we actually fenced in some of them to make it look a little bit better. So we put like a nice wooden fence around the dumpster so that even if it did overflow, it wouldn't look as terrible or wouldn't be as visible to everyone on the property. So that was just an interesting story, specifically to share. Another story is, as you think about what your tenants want as you rehab, we thought about what product do we want to bring. I'm sharing the second picture in on the top now is carpet on the stairs. We thought about, okay, do we offer carpet in the bedrooms and the stairs, or do we all want to offer vinyl flooring or hardwood flooring throughout? And we tested a little bit of both. Actually, we ended up trying to see what tenants wanted. We ended up going with more of the vinyl flooring. We thought it looked a little bit better, it was a little bit more durable. And we actually wanted to pitch and market our property as kind of a pet friendly property, right? So with everyone having individual entrances and lots of outdoor space here, we wanted to kind of differentiate ourselves and be a pet friendly property. And having carpets in the unit, right, that doesn't lend itself to kind of durability and a little bit more costly on turnovers, right? If you have pets in there more often than not, the carpet's going to get damaged at a higher rate. So that was something we had to think about and adjust as we went, right? We had to go and make an adjustment there. In some cases, we took the carpet out and then replaced it with the vinyl flooring. And then on the right is an example of, you always have to kind of think about what additional value add can you offer the tenants to increase the revenue out of property. So on the right is a story there's nothing in that kind of space, but there's a washer dryer hookup there on the wall. Most of these units did not have washer and dryer in them, or some of them did, but they weren't running. So we thought a value add opportunity could be, we could offer the tenants, we could bring in washer and dryers at additional cost to them to have washer and dryer directly in their unit. We could set that up for them at additional fee. They could have that in there directly in their unit. And that would be some additional revenue for us, and obviously a huge convenience and attraction for tenants as well. So that was kind of a value add proposition which we brought to the units, which previously wasn't there. And then lastly, on the bottom, always thinking about branding and kind of signage and making sure our property is visible. That's always an important thing. We added a website, for example, with kind of like drone footage of the properties, and we're actually currently going through and bringing someone in to kind of do some of those like 360 virtual tours. So they're coming, take all the pictures and video to make that possible and add that to our marketing materials. So you always have to kind of think about, and we're constantly thinking about, what are those ways to kind of get more eyeballs on your property and make sure it's being marketed in the right way. So those are just some of the challenges and things that we thought about this property that we have here in Louisville. And as you go through each property, you have to come in and think about your business plan, put that in place. You have to put in place your new policies and procedures, and then you have to have the right property management on staff. If you're not going to be there yourself or managing yourself, then you have to hire the right partner, and that you have to make sure that what they're delivering matches your expectations. In a lot of cases, they might not be up to that standard, right? You may not know that until kind of they operate for a little bit and circumstances come up, and so you have to kind of find the right person and partner in that end as well. So that's just some of the stories on the asset management side. So that's really where operationally you make these deals work, right? It's turning the units and getting good product and keeping your eye on what the competition is doing and making sure tenants are getting a good unit and they're staying, right? We don't want turnover. So we want to make sure tenants are happy. Every time a tenant leaves, we have to market it. That unit could sit vacant for a couple of weeks, and that's lost revenue for the property and for the investors. So that's something we're always focused on, and that's a challenge as well. So I'll just pause again as I kind of come to the final stage here. So this project, so as everyone knows, real estate market's been really hot, right? So we've been executing on our business plan. As you can kind of see here at the bottom, it was 32 units across many different across many different buildings. There's 32 units in these townhome style buildings. So we're gone through and making improvements to the exterior, making our improvements into the interior, and spending our CapEx budget. Managing that budget, make sure we're staying within budget. So this project, luckily so far, we've rehabbed over half the units in under a year. So that's been good progress. We've completed a majority of our exterior renovations and our infrastructure repairs. But some of the challenges you might think of is, inflation, right? So the inflationary pressures that we've had on the labor costs, or just the challenge of getting the contractors on site. That's been something we've seen with this property and others. That's been a challenge. And then the cost of materials going up, or the availability of even materials. Appliances have been tough to get, or certain things are, even for a while, cabinetry was hard to get. So the timing of that all kind of impacts the project. So getting to a cadence is really important on that. So like I mentioned, the market has helped our cause, of course. With the market going up, we've been seeing higher rents. We've obtained higher than expected rents than our underwriting. So that's all great news. Louisville as a metro area, and specifically the sub-market or neighborhood we're in, has really been doing well and seeing lots of new and exciting things come in. So that's bringing in new renters as well. So it's been really good. And a lot of that is due to our business plan, our hard work, but a lot of that, as always, is out of your control and is due to the kind of the market, right? So that's why we like real estate as a whole, right? And it's kind of had a great run, and here we are at a unique time in the market where things are changing a little bit, but we still see real estate being a promising investment class for investors. And then lastly, the investors, right? Making sure this project, we've been really focused on getting our cash returns to the investors and making sure they're getting communication from us regularly, including pictures and kind of tidbits about what's going on at the property and what's going on at the area in general. That's just everyone that's involved in this project is also limited partner investors in similar apartment complexes, right? So we are on both sides of the spectrum, right? So we know exactly what people want to see. And we put ourselves in their shoes at all times, and making sure that putting the investor first is kind of our philosophy. So that comes with communication, that comes with making sure they get the returns. And hopefully, ultimately, when we if we ever, when we end up selling or refinancing or whatever the exit strategy ends up coming to fruition, making sure our investors get hopefully a nice juicy return on this project. So that is our Louisville 32 unit project that I just went through. Spent quite a bit of time there. I left about 10 minutes here at the end for any questions or things that you guys might want to hear a little bit more about or more specifically about. I tried to keep it a little bit high level, but dive into a couple of specific stories. But would like to hear from you guys. Any questions or anything you'd like to hear more about? Let me know in the chat box, or let's see here if I can take any questions. So go ahead, guys. I'll wait another minute or two, see if I have any questions. You could hit the raise your hand button, and I'll unmute you to talk, or you could add them to the chat room. All right, I am not seeing any questions come through. As I close out here, if you do have any questions, I'll pause and come back to it. But yeah, it's been great to share this experience with you guys. Hopefully, for those of you that are on this evening, you've gained some insights to how I and others look at kind of valuation of projects, and then how some stories of the acquisition process, and then some stories from the asset management side of it. If you have any questions or want to learn a bit more, reach out to myself or Alina. We share our contact information earlier. You can reach us on any of those. And I just saw a question come in, Fabrice. Awesome. So the question I'm seeing from Fabrice here is, what part of the evaluation process is most difficult? What part of the evaluation process is most difficult? So I always find, I think finding the properties to underwrite has been a challenge. There's been, with the run up in real estate, a lot of the valuations have gone up, and we've been underwriting a lot of properties that are not penciling out right to the returns that we want to see. So for me, and for a lot of folks I've talked to in the space, constantly underwriting deals or even just evaluating deals, and seeing that the valuations are run up has been what I'll call the more difficult part of the process. Or a lot of times you'll see kind of folks, sellers maybe just pad the numbers a little bit and make it a little more attractive. And then once you kind of dig a little bit more, and maybe they're more optimistic on the upside than you might be. So once you kind of dig in a little bit more, you kind of see it's maybe not as viable or not as juicy as a investment potential as the broker or the seller proclaims it to be. So for me, it's really the time commitment, the valuation process, time commitment to go through so many properties and find the right one. Making all those assumptions, trying to be conservative, right? Trying to balance that act of being conservative in your underwriting, not trying to be overly optimistic or rosy, is really important, right? You don't want to underwrite, these rents to continue to skyrocket at 5 to 10% growth a year, because that's just not realistic. Right, that's going to slow down. It has started to slow down last month or 2 months or 3, right? That started to slow down. Over the last 12 months, we've seen rents go up in some markets 10% or more, and that's not sustainable, right? So when you're doing your underwriting, you want to stay conservative, but you also want to, you're eager to do deals, you're eager to invest. It can become a bit of a patience game, right? So that at times, that at least in this market, that's become maybe the most difficult part, is just staying patient, staying true to that investment criteria, and making sure you're staying conservative in the underwriting. So Fabrice, good question. hopefully that answered it. Guys, anything else? Excellent. Well, I hope to hear from a lot of you. Again, please reach out via email. We shared it earlier in the presentation. For those of you that watch the webinar later on, feel free to scroll back to that point. But hope to see you or talk to you guys soon. And we'll see you again in a month. First Wednesday of the month. We'll have a new topic to share with you guys. All right. Bye, everyone. Have a good night.